The top business stories live from the Sky News City studio. The Chancellor insists his tax cuts are all about economic growth, not the next election, as UK business activity increases unexpectedly in November. Virgin Money to set aside more cash than expected to cover bad debts as its full-year profits fall. Plus, is Black Friday just a gimmick? We'll hear from the car brand that says yes, it is. Good morning, this is Business Live with me, Ian King. The Chancellor, Jeremy Hunt, has been touring the TV studios this morning, insisting that his tax cuts are about long-term growth for the economy and nothing to do with the timing of the next general election. Meanwhile, forecasts from the Office for Budget Responsibility show that taxes are still trending upwards. But there was some good news for the Chancellor this morning, as the latest Purchasing Managers Index survey data suggests that UK business activity rose unexpectedly in November. Well, our economics editor, Ed Conway, is with me now. Ed, what do you think 12 to 14 hours on the messages from this statement now?
I think interestingly, you know, that kind of the day two today is supposed to be the day when we get all of the analysis from the IFS, the Institute for Fiscal Studies, the Resolution Foundation. And it's often that moment where it turns out if there's some small print that no one's noticed, you kind of get to the bottom of it and the narrative sometimes shifts. But actually this time around, as far as we can kind of make out so far, it's more or less the same conclusion that I think we were coming to yesterday afternoon. This is, you know, it was a significant autumn statement. It was a significant fiscal moment. There were tax cuts. However, those cuts barely reversed. In fact, they only go a tiny fraction of the way to reversing some of the tax increases that we've had recently and are going to continue to have. So the tax burden is rising. The broader picture, as you were saying, is, you know, there are some interesting changes here. There's some shifts in terms of things like full expensing, lots of what the Chancellor billed as business-friendly measures. I mean, some of them are really quite small, but you know, it could all help to generate investment. And we have obviously just seen, and doubtless you'll be talking about the fact that Nissan are going to be putting more money into the UK, building more cars in the UK. So there are some positives here. And obviously the PMI survey, that latest kind of benchmark for how well the economy is doing, is a little bit better than expected. But take a step back, and the broad picture is definitely of an economy that is much weaker looking out into the future than was previously thought. The OBR cut their growth forecast by quite a lot. And I think what's most striking, one of the most striking charts I've seen so far today, has been one looking at the standard of living in the UK and just how it's changed in each parliamentary term. It was put together by the Resolution Foundation. And basically it shows that every single parliamentary term, going back all the way through to Macmillan, you're seeing those living standards improving up until now, up until this parliament, the parliament that began in 2019. Living standards have fallen, and in fact they're going to continue falling in terms of real household disposable income. It's quite a good measure of just how well off or badly off you're feeling from one year to the next. It's falling at the moment, and it's going to continue to fall into next year. And so although definitely the Chancellor will want to try and kickstart the economy, it's so hard to fight against that big kind of wave of disappointing living standards that we have in the UK. Worth saying, similar story in much of Europe as well, because a lot of this is down to what's happened to energy prices. You know, it's a big shock in terms of our standard of living. But even so, it means that it is unlikely to be a feel-good factor, even though those tax cuts come in a little bit earlier than expected, because they're outweighed both by the economic news and also by the fact that you have that increase in tax rises that we've seen from the government recently. So there's quite a lot up against the Chancellor. But yes, he has been making as brave a face as he can of the news this morning.
OK, thanks, Ed. Some other stories for you now. The price cut on household energy bills will rise by 5% on New Year's Day, following a rise in wholesale gas prices. Ofgem, the energy regulator, said the cap would rise by £94 over the course of a year, around £7.83 a month, to an average of £1,928 per year. Ofgem said the price increase was driven almost entirely by rising costs in the international wholesale energy market due to market instability and global events, particularly the conflict in Ukraine. Virgin Money has had to set aside more money than expected to cover loans it does now not expect to be repaid in full. The lender set aside £309 million for the year to the end of September, up from £52 million a year earlier and more than expected, which it said mainly was due to credit cards. Virgin Money also announced a £130 million investment programme over the next 3 years to significantly upgrade its financial crime prevention and cyber defence capabilities. The lender's underlying full-year pre-tax profits fell by 24% to £593 million. Tour operator Jet2 said this morning that bookings for this coming winter were slightly lower than they were this time last year, noting that they had been a little slower in recent weeks. Well, the news sent shares of Jet2 down by more than 2.5%, even though the company also said that bookings and pricing for summer 2024 were currently ahead of where they were a year ago. Jet2 was reporting an operating profit of £617 million for the 6 months to the end of September, which was up 19% on the same period a year ago. The consumer goods group behind Imperial Leather Soap and Carex hand wash said today that it expects sales growth in its new financial year to be better than in the last one. PZ Cussons said this mainly reflected strong growth in Nigeria, Australia and New Zealand, along with significantly improving momentum in its UK washing and bathing brands. The Manchester-based company, whose other brands include Saint-Tropez suntan lotion and Original Source shower gel, confirmed it will buy out minority shareholders in its Nigerian arm by the end of May next year. The shares have risen 1% today. Well, the pound has risen on the foreign exchange markets this morning after flash Purchasing Managers Index survey data suggested the UK economy returned to growth this month. With anything above 50 representing growth and anything below that a contraction, the flash reading, which is based on around 85% of survey responses, came in at 50.1, up from 48.7 in October and the highest since July. You can see there, sterling up by 0.5% against the dollar and up by nearly 1/3% against the euro. The single currency, meanwhile, is up 0.25% right now against the dollar. Well, on the equity markets, following another good showing from Wall Street last night, stocks in the Asia-Pacific region enjoyed a largely positive session overnight, although Sydney finished lower following a warning from the Australian Reserve Bank on inflation. Sydney off nearly 0.2%. In Europe, stocks are largely in positive territory this morning. The MIB in Milan, the only one of the major indices letting the side down. The AEX, which is the main Dutch stock index, is completely unchanged on the result there of the election. Talking points in Europe today include Colt CZ. The Czech owner of the Colt gun brand is up 1% in Prague after it made a $1.7 billion takeover approach to the US sporting and outdoor goods retailer Vista. Well, here in London, the FTSE 100 is off 0.25% in mixed trading this morning. In terms of the gainers, the leading percentage gainer is the testing and safety standards group Intertek. That's ahead by some 3% on a trading update, 3.25% now, in fact, while BAE Systems is benefiting from broker comment. That's up nearly 0.5% right now. Outside the FTSE, the ready meal maker... It's not the ready meal maker I wanted to talk about. They had results out earlier in the week, Cranswick. Their shares up by some 2/3%. It's actually Bakkavor I wanted to mention. They're the ready meal maker. They're ahead by some 5.5% on director buying. Quite an illiquid stock, that one. Meanwhile, the motor dealer Motorpoint is off by about 5% after a downbeat trading update. Meanwhile, the oil price saw a big sell-off yesterday. It rallied last night, but it's fallen again this morning. Barrel of Brent crude will currently set you back $81.10 a barrel. That's off 1% on the session. Well, joining me this morning is Sanjeev Tumka. He's head of equities at Rathbones Investment Management. Sanjeev, good to see you again. Mentioned Intertek there, one of the lesser-known companies in the FTSE 100, but it really is quite a consistent generator of profits.
Yes, it is. It's quite a defensive business. It supplies testing, safety services, certification services. So it's kind of essential to global trade in goods and services. It's going through a slightly better period at the moment. So we saw organic sales growth of 5.2% in the last 3 months. No, it was even higher than that, 7% earlier. COVID's obviously created some sort of volatility in its reported earnings, but what it's guiding to is mid-single-digit organic sales growth going forward. The interesting point is, if you look pre-COVID, 2014 to 2019, it only achieved an average of 1.7% average sales growth. So can it push it up to mid-single-digit, which is sort of 4, 5, 6%? That's the question that the market's asking at the moment.
Is it an easy stock to analyse in terms of it doesn't have many peers that you can measure its performance against, does it?
There's a couple of other big global peers, but they all do slightly different things. So there's SGS and Bureau Veritas in Switzerland and France, and a few other smaller ones. But they all cover slightly different areas. With Intertek, quite a lot of what they do is consumer products, so particularly goods made in China for export to Western markets. Now, as we know, China Western trade has gone through quite an interesting last few years, and there's quite a lot of onshoring going on. So the argument is that if you're relocating your manufacture of your T-shirts from China to Vietnam or even to Mexico, then you need to reroute your testing and certification services in order to make sure that you're still getting consistency of product. Yeah. And that's where Intertek comes in, because it's got a global network.
It is fascinating business. Another one reporting today, just outside the FTSE, Mighty, a company that's had varying fortunes over the years, but it's definitely on an uptick now, it feels.
Yes, no, definitely very varied fortunes. It used to be a stock market darling, then it again went through a big period of the doldrums of 2015 to 2020, had a rescue rights issue. It feels like it's really coming good now, though. So we saw, I think it was 24% profit growth in the first half. The operating profit margins going up from 3.5% to 4%, so all very consistent. I think the trouble with Mighty was the accounting policies weren't as clear as they could have been. There was a lot of volatility in cash flow, in working capital, and the management team have now really focused on reporting profits in as clean a way as possible. The market understands that the business a lot better, has faith in the results, and we've seen that in the trajectory of the share price and the earnings.
Yes, I mean, Phil Bentley, the former Centrica CFO, has pulled around a textbook turnaround there. But it's interesting when you look elsewhere in the sector. We had an update from Capita earlier this week, which is a much diminished business from where it was a few years ago.
Yes, I mean, this whole sector was an absolute darling of the stock market 20 years ago. Capita, Serco, Mighty, they've all in different ways had issues. I think part of that is just dealing with the public sector, where public sector budgets have been under pressure. So I think they've all been through those issues. I think Serco and Mighty coming through that and out the other side. I think with Capita, it's still kind of an ongoing restructuring. So more volatility, I suspect.
Yeah, John Lewis, the CEO, inherited a tough business to turn around there. And a property company caught your eye as well today, Sanjeev.
Yes, London Metric Property. Again, not a kind of a FTSE 100 kind of headliner, but doing really good things in kind of the mid-cap space. So it focuses on industrial logistics, urban logistics and distribution centres. That's kind of more than 70% of its portfolio now. And what's really interesting is it's posting portfolio growth at a time when portfolio values are coming under pressure from those higher interest rates. But what it's achieving is rental growth at a time when that's quite hard to come by. And part of that is because the way it's structured its contracts. So something like 60% of its rental contracts have automatic uplifts, either fixed uplifts or related to RPI inflation. So that's a great thing to have at times like this.
Indeed it is. Sanjeev, good to see you as ever this morning. Thank you.
You too. Thank you.
About 3 weeks ago, we brought you news that Vodafone is selling its Spanish business for €5 billion. The buyer is Zagona, a UK-listed business specifically set up to invest in telecoms assets. Its founders are Eamon O'Hare and Robert Samuelson, two former Virgin Media executives who previously helped turn around the company's struggling cabling businesses. Well, joining me now is Eamon O'Hare. Here he is. Eamon, good to see you this morning. Thank you. You've just completed a £262 million share issue to help with the acquisition, but this is largely being funded with debt, this acquisition.
Yeah, it was a €5 billion acquisition, and we have secured debt funding of just over €4 billion from three large global banks. And we've gone out recently in the last 2 or 3 weeks to just nudge that debt number down a little bit by raising €300 million, as you say, £280 million of equity. We also have quite a considerable financing package from Vodafone as the seller of the deal, and we've been able to structure that financing into Zagona equity. So actually, the market cap of the business is going to be well over £1 billion or €1.2 billion.
Some people might say, though, that this is still quite a big gamble on your part, a heavily debt-laden acquisition of a business that's number 3 in its market and somewhat struggling.
Well, the business has got 1.3 billion of EBITDA. We're acquiring the business at under 4 times, and the leverage is going to be 2.9 times, so less than 3 times. And we quite like that crossover credit zone where you're kind of sitting between 2 and 3 times leverage. So it's quite a sizable business, 4 billion of revenue, 1.3 billion of EBITDA. So we think the capital structure is very much fit for purpose.
So how are you going to accomplish this turnaround? I mean, I've seen a lot of speculation that you're going to launch a price war. There's obviously going to be cost-cutting involved here.
Yeah, we don't think about it that way. Look, we're acquiring a business with great assets, the number 3 player in Spain. It's got a very big enterprise business. It's got great brands. It's got great people. It's got great fixed network, gigabit-capable network, access to over 92% of the homes in Spain. I mean, that's terrific reach. Also, the mobile network is best in class. So we're buying a lot of very good assets inside the business. But the business has been, in our view, underperforming. Its cash flow is only 10% of its revenue. We owned a business very recently in Spain, in the north of Spain, a company called Euskaltel, which was Basque Telecom effectively. And it was a business that was strategically slightly less attractive, more geographically constrained, didn't have its own mobile network. And we were able to get the cash flow margins of that business to 27% of the revenue. So as you can sort of see, as we move from 10% somewhere closer to 27%, there's quite a considerable upside potential for the business.
Now, you've chosen to retain the Vodafone brand name. Why is that?
Well, we think it's a great brand. First of all, 33% of the business here in Spain is actually very big enterprise customers. Vodafone have a very big enterprise franchise in the UK, and they've imported that into Spain over the years. We quite like that. We like that B2B segment. And Vodafone as a brand resonates very strongly in terms of security and quality with the large business customers. So that's the first thing. Second thing, we've actually secured the brand for 10 years. And thirdly, we're not having to pay anything for it. So it's a very high quality brand. And we think we can leverage it even more significantly into the marketplace. And then when we don't have to pay anything for it and we're getting it for 10 years, well, why not?
Why not? And of course, Vodafone do participate in the upside if you do accomplish a turnaround here.
Well, somewhat. They have provided us with 900 million euros of financing. Their upside is capped. They clearly are exposed to what we deliver, and we do owe them that money. And we hope to get the money back to them over the next 2 to 3 years. But it's not like they don't have an equity exposure to the business. It's kind of a structured financing mechanism that allows them to basically receive that money back over time.
Now, you've modelled yourself pretty explicitly on Melrose, the listed UK turnaround specialist here, buy, improve, sell. How long do you anticipate holding on to this asset for?
Well, you're quite right. I mean, look, when I founded the business back in 2015, we admired Melrose from afar. They basically employ this strategy in the industrial sector and have been fabulously successful. They've been going over 25 years. They've done 5 or 6 different deals. This is our 3rd deal. We've progressively gone from our first business we bought for 600 million euros. We got involved in Euskaltel quite recently and sold that for 3.5 billion euros. And now we're moving on to the 3rd deal at 5 billion euros. So we're kind of moving along the curve, not unlike Melrose have done over the last 20, 25 years. For us, the timeline, these businesses, they're very big businesses. They have a very strong cadence. This isn't kind of a 1 or 2 year thing. This is a 3, 5, 7 year kind of investment play. So these are quite long-term investments. It takes time to basically manage these businesses to the optimum financials that you want to get them to.
Well, best of luck with the turnaround, Eamon. Hope to hear from you again in the future. It's a good chat today. Thank you.
Thank you very much, Ian. We really appreciate it.
Still to come here on Business Live, the car brand that's rebelling against Black Friday. Don't go away.
These are the creatures which are responsible for stranding Columbus in the Caribbean. They ate his boat. But the key thing here is we have an organism which does something pretty remarkable. It can convert wood into nutrient-packed protein, rich in B12, rich in micronutrients. So they taste like oysters. So they're really quite appealing, actually. But our vision is for a mass market product, really. So this is the sort of thing you put in your fish fingers and your fish cakes and that kind of thing. So we're really envisioning a big scale here. You know, if you're trying to do something sustainable, it's no good doing it and selling it to a restaurant every 2 weeks. It's got to be something which is in every single supermarket around the country to actually make a big impact on people's nutrition and health. So our vision is for large open sea farms or large urban setups for this, and for this to be put into foods that people are familiar with already.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Welcome back. Now, tomorrow sees that most unappealing of American imports to the UK, Black Friday. But is it really anything more than a gimmick? Well, the value for money car brand Dacia thinks not and is shutting down its entire online sales tomorrow to prove it. Well, joining me now is Luke Broad. He's brand director of Dacia UK. Luke, welcome to you. I mean, shutting down your online sales operations for the day seems a bit drastic.
Yeah, it seems a bit drastic, but at Dacia we really wanted to make the point that good value for money shouldn't just be for one day, right? And that's why at Dacia we offer good value for money all year round. And we really think that putting our money where our mouth is, closing the online sales of the website for one day really makes an anti-stance against Black Friday.
Well, more power to your elbow for doing that. I mean, do you see many of your rivals participating in this event?
No, we don't. Not within automotive, but we'll see what happens tomorrow, obviously. There's other brands outside of automotive who are sort of joining the club, as it were. But as far as I'm aware, we're the only brand in the industry doing this.
OK. How have you been trading in the UK lately?
So sales have been going really well. I guess the value proposition of our brand, especially in a time where customers are looking to make every pound in their pocket stretch further, Dacia is a really interesting proposition for those customers. So overall, really, really good. We've got some great products coming next year as well. We know that the electric vehicle market is one that is growing, and that's why next year we'll be launching the most affordable car in the UK, and this is something that we're really, really excited about because all of a sudden it will democratise electric vehicle ownership for the masses, so something we're really excited about.
Yeah, this is called the Spring. It launched elsewhere in Europe in 2021. Why the delay in bringing it to the UK market?
To give you the honest answer, it's because we couldn't fulfil the orders for the left-hand drive market, but now we're at a point where the production is looking good. We've managed to engineer the car to a right-hand drive version, and we're taking the opportunity to launch it next year in upgraded guise. So super exciting.
OK, where are the cars manufactured?
So the cars are manufactured in China under a partnership with Dongfeng, and they're obviously imported into Europe and then the UK.
I don't know whether you saw it yesterday, but the Office for Budget Responsibility reduced their forecast for sales of electric vehicles in coming years. Were you surprised at that?
I wasn't surprised, but if we're being honest, who can really forecast what is going to happen in the next 3, 4, 5 years? As an automotive industry, we're all galvanised. We know the direction of travel. We've got clear targets from the government. It's now our job to make that happen in partnership with the government as well.
But obviously charging infrastructure does seem to be weighing on sales of EVs in this country.
Yeah, so we know that one of the barriers to entry to electric vehicle ownership is charging infrastructure. More than 50% of people in the UK can't have a charging point installed at their house. So it is important for a lot of people. The announcement yesterday to remove a lot of the red tape regarding getting infrastructure installed in the UK will surely help, and it will remove one of those barriers. And from an automotive perspective, we're trying to remove as quickly as possible the price barrier.
So when you launch the spring next year, what proportion of UK sales do you expect that to account for by this time next year?
So of all the cars we sell, we're being cautious, I would say, because who knows what will happen with supply and production and all this topics. However, we think around 10 to 15% of our sales will be of this product. So we're really targeting strong sales volumes with this car.
Non-trivial. And how important is the UK market for the Dacia brand more broadly?
Super important. You know, we see that in Europe, the brand is performing really well. Dacia Sandero, it's the #1 selling retail car in Europe, and the Dacia Duster, it's the #2 SUV in Europe. So Europeans have a real appetite for the brand. And for me, I see no reason why that can't be copy-paste UK market. So.
And do most UK customers buy the car through a PCP, or do you get a lot of people buying it outright?
Yeah, so at the moment, around 50% of our customers buy cars on finance. Obviously, with the rise in interest rates, with Bank of England base rate increasing, we're seeing a slight dip in that at the moment, but we're trying to manage and support our customers get access to accessible mobility as affordable as possible in the context of all of those headwinds. However, 50% of our customers do buy with cash, and we, of course, offer the best value for money cars in the UK.
All right, Luke, got to leave it there. Good to see you this morning.
Thank you.
That's it for me for the time being. I will, of course, be back at 4:30 with our afternoon edition, when my guests will be including a prominent figure from the property sector. Do hope you can join me for that.